Oil prices fell on Monday with the global fuel demand outlook overshadowed by COVID-19 restrictions in China and the potential for further interest rate hikes in the United States and Europe. Brent crude is trading at $91 a barrel and WTI at $85 a barrel. That's around the level that oil was trading at before the conflict in Ukraine. China's oil demand could contract for the first time in 2 decades this year as Beijing's zero-COVID policy keeps people at home during holidays and reduces fuel consumption. But according to some analysts, global oil prices may still rebound towards the end of the year as supply is expected to tighten further when the European Union embargo on Russian oil will take effect in December. For more on this now, let's go to Han Tan, who is the Chief Market Analyst at Exinity Group. Han, many thanks for being with us today. So first of all, what is the direction of travel of oil prices at this point? Because there's a lot of different moving parts. Can you explain?
Yeah, I think right now oil prices are finding this firmer footing after having shifted lower since mid-June or so, right? And that's due to several factors. One, there's of course with central bankers around the world raising their respective interest rates, all in the name of demand destruction. So there's that fear that global demand is not resilient enough to keep prices elevated, right? Also, you have this red hot US dollar, which makes oil prices more expensive, at least in recent months. But then having said that, even with the moderating US dollar, even as we speak right now, you see those demand side fears still placing a cap on oil's upside.
Surely, and very different than we were hearing JP Morgan's prediction, hedge fund managers' predictions that were looking at potentially oil prices standing at $180 a barrel, even $200 a barrel just a few months ago, a few weeks actually. But what effect do you expect the European Union embargo to have on oil prices in December? What kind of impact can we expect?
Sure. So now, obviously, on the demand side, that would be a negative because it then amplifies the recession risks. But then, having said that, that also means that there could be this a return to the fears around the supply side scarcity. That's been a tailwind for oil prices, for much of this year, really, in the first half. So, we expect that narrative to continue if that import ban comes into full effect in December. But also keep in mind that a lot of the near-term trajectory for oil prices is contingent on the demand side, and China plays a big role in that. So as long as China can take continued steps with its post-pandemic recovery and reopen its economy, then I think we should see plenty of support, at least from a fundamental perspective, for oil prices.
Interesting. Han Tan, many thanks for this update.
Thanks for having me.